Your price wins the deal, but only rate control saves the profit.
You close the deal. The client pays in USD. Everything looks profitable until the exchange rate moves. When your revenue is in USD, but your costs are in THB, you face transactional FX risk. Each time the baht strengthens, your USD revenue buys fewer baht. The result? Your margin evaporates quietly. This is the invisible enemy of international pricing. A 3% appreciation of the baht can wipe out your entire project profit before delivery. That's not bad management, that's unhedged exposure. In cross-currency business, it's not the rate you quote that matters, it's the rate you keep. Curve showing profit shrinking sharply as THB strengthens, 36.34. Label: every 1 THB shift equals margin risk.
When you price in SD but pay in THB, your margin lives in the exchange rate.
The spread between your quoted USD rate and your actual conversion rate defines your real profit. Let's visualize it. Example: quoted price equals $1 million, cost equals THB 35 million, implied FX equals 35.00. If the baht strengthens to 34.00, you receive THB 1 million less. That's the difference between success and loss, and you didn't even see it coming. Your operational team did everything right, but your financial spread vanished in currency translation. That's why margin protection starts long before the first invoice. It starts at rate planning.
Exchange rates don't ask permission, but you can still prepare.
You can't control markets, but you can control exposure. The goal is simple: lock your rate differential before volatility locks your margin. Here's how the 3 main hedging tools work. 1. Forward contracts, the classic shield. You agree today to exchange USD at a fixed rate in the future. It's simple, predictable, and powerful. You know exactly how many baht you'll get, no surprises. The trade-off? You lose upside if the baht weakens. 2. FX options, flexibility with protection. Options act like insurance. You buy the right, but not the obligation, to exchange at a specific rate. If the rate moves against you, the option saves you. If it moves in your favor, you can let it expire. The cost? A premium upfront. But that premium buys peace of mind and flexibility. 3. Natural hedge, offset inside operations. Match inflows and outflows in the same currency. If you have USD inflow, use it for USD-denominated expenses, like raw materials or loans. No derivatives, no premium, just smart balancing.
Don't predict the market, design your protection.
Hedging isn't gambling, it's engineering stability. Start by measuring how much a rate change affects your margin. For example, a 1 THB move in USD/THB can shift your project profit by 3%. If 80% of your costs are in THB, hedge at least 70 to 80% of your exposure. And if your project spans 12 to 18 months, use layered hedging, 50% now, 30% later, 20% flexible. This approach balances protection with opportunity. By quantifying risk, you stop guessing and start managing.
The strongest hedge isn't reaction, it's preparation.
Most FX losses don't happen because companies lack tools. They happen because teams hesitate. They wait for a better rate. They hedge after the damage. They ignore timing mismatch between invoices and payments. Professional CFOs treat hedging like insurance. You don't hedge because you expect disaster. You hedge to make sure it can't destroy your quarter.
Waiting for the perfect rate is the fastest way to lose your margin.
To keep your USD/THB spread intact, apply 5 simple steps. Set your target rate before quoting. Define your hedging policy, what percentage and what duration. Use layered hedging to cover long projects. Track cash flow in both currencies, not just in accounting reports. Align sales, finance, and procurement under one FX assumption. This isn't extra work, it's intelligent control.
Control the rate, and you control the story behind your numbers.
Let's bring this to life. A Thai exporter sells $100 worth of goods at an exchange rate of 36.00 THB/USD. The expected revenue equals THB 3,600. The cost equals THB 2,880, 80% of total. Expected margin equals THB 720 or 20%. Now, if the bot strengthens to 34.00, revenue falls to THB 3,400. Cost stays the same. Profit drops to THB 520, a margin collapse of 28%. But if the company hedged at 35.00 THB/USD, the margin stays stable at 18 to 19%. This is the power of spread protection.
You can't control the market, but you can design your outcome.
Exchange rates don't destroy profit, unprotected exposure does. When you lock your rate early, you're not gambling, you're buying stability. And stability builds confidence with your investors, your board, and your customers. Every CFO knows volatility can't be removed, but it can be managed. The real win is not avoiding risk, it's designing resilience.
If this changed how you see FX risk, subscribe and join me, Thanya, where finance becomes foresight. If this changed how you see FX risk, subscribe and join me, where Thanya, where finance becomes foresight.
Protect your price, hedge your cost, and keep the spread before the market takes it.